Thanks for joining us, folks. Here again with Martin. We're looking at doing part three, entrepreneur versus investor. This is part of the COVID series we've been touching on. And if you missed the first two, I'd urge you to go back and take a look at those. Some really interesting statistics just regarding the economy, some metrics which businesses are thriving. Um, I really, this series has been really applicable to business owners, and really excited to hear what Martin has to say about this particular topic.
Thanks, Jim. It's great to be here with you. Speaking about these financial matters, our team works with business owners, and we work in the transition. So where you kind of finish off with your work, then we transition, take the client from there, and project forward. Which is and it's great to be working with you on some of these cases. As we see, conversations with business owners. There's more confidence and there's more understanding and just seeing the entire landscape. So the first two parts, we wanted to cover what's happening in the economy and overall what's happening in different industries. And in this last part, I wanted to focus on the transition from entrepreneur to investor. And that's generally what's happening when business owners selling their business is moving on. And it's not like you're not a business owner anymore. You know how businesses work. You just become kind of an owner of many businesses when you have investments in larger corporations. And there is a dynamic to that. And as an investor, there's different behavior than an entrepreneur. I wanted to have a bigger picture look at market cycles and long-term view of markets. And looking at when markets started being tracked accurately back in the 1930s, $1,000 invested back then would be worth about $1 million today. So generally, we know that in the long run, markets go up. So anyone that is invested in the market it will come out with a profit. At the same time, these lines are not straight. There are bumps along the way, and those bumps are related to tougher economic times like recession. During these times, if one was not an investor before, and if maybe your focus was so much on the business that you never really thought about the investments because you knew that your paycheck comes from the business, you really have to start thinking that now your paycheck will be coming from investments. And having a stronger understanding of that will give confidence to the individual to understand of, how will that new paycheck be generated. And that's the job of my team, where we work with business owners in creating a financial plan, both on the investment side, obviously because of the assets, but also on the tax side. If you earn 5% in interest and you earn 5% in the market, the net value after tax is not the same. You're going to get a lot less if that income came from interest. So you have to align your finances according to what the goals are that you have in the long run. And also be able to get through the ups and downs emotionally. And if you're not used to it, it can be scary. In the previous sections, we talked about how it is actually a great opportunity to transition assets from a business into an investment portfolio when the market is down. When assets are down 20, 30%, it's like a business owner that is able to buy, a machine for their business at a lower price, either at a discount or maybe there was another business that was distressed and you're able to acquire those assets. And that's what same thing applies in the market. Now, how long are these windows for opportunity? Because we don't necessarily have the time to think about, I'm selling my business and the market will be down right at the same time. We are dealing with volatility, and we had initially earlier in 2020 a drop in the market. Then we saw a recovery. Will there be a second wave of COVID that will create another opportunity for entering into investments? We don't know, but we need to be thinking about it. We need to be able to position ourselves, and I would say that the next 7 years will be probably interesting, because when things go in waves, you want to get in at the beginning of the wave, not at the end. So if every crisis has a solution and we proceed from there, then how will that work this time? Looking back at past trends, if that can be of any indication, going back to 1960s, all the way to the financial crisis of 2007, 2008, what we're seeing is that when there is a recession, GDP drops. And the more it drops, the longer the recession. It may be a little bit different right now with COVID because the market or the economy did not drop on its own. It was actually created by the government. And so that will be a slightly different look at it. But you can see that most recessions, there's a recovery within 4 quarters or just about a year. Some recessions will last about a year and a half to maybe 2 years, where GDP dips and then it comes back to where it was. The financial crisis, which was one of the largest recessions in the recent history, actually dropped 4%. And it wasn't this overnight, but it was over a period of a year and a half that there was a continuous decrease in GDP. And then it took about 4 years for the GDP to recover. So it took about 4 years for the economy to get back to where it was initially, and then from there start growing again. So if we're talking about the window of opportunity, the few months that we had at the beginning of the year when the markets were down, maybe that's not yet it. Maybe it's not over. Maybe it happened too quickly, and that's why the market rebounded too fast. Looking at long-term trends, so if we take an average since 1929, where markets dipped and they recovered, the dip itself lasted about 1.3 years. And the market at that point dropped 38%. Subsequently, the economy then expanded for 6.6 years and about over 300%. So we definitely know that those expansions last longer, and there's a lot more growth, about 10 times more growth than there is on the decline. So the opportunity, what we want to look at is this window of entry. And if we're able to, if business owners are able to come to an agreement with the buyer during this time, even if maybe there is a little bit of negotiating to be done and to give a little bit from the seller side, it may be a very good opportunity to do that if you're then able to get into an asset at a lower price. Averages are great, but reality is different. So this slide here breaks it down where we look at, again, since 1920s, where the blue parts is where the market grows, and then the yellow parts is where the market shrinks. And the shrinkage is also coincides with these gray bars, which are recessions. So we're seeing that markets have expanded as long as almost 15 years and have gone up as 900%, and then there was a drop and growth and drop. So if we came to an end of this growth and then we have this drop that's happening right now, essentially we're stuck, at this point where we would expect that the next 5, 7, 8, 10 years, depending how long the next one expansion is, then in that case, this is the ideal point of getting in. So turning the fear upside down, look at it as an opportunity as opposed to a problem. And this is to connect where you are, where you have been, to where you're going. I think this is where the conversations about greater than just the industry itself or the business that the business owner is exiting is important. So this is also a natural transition to investment management during volatility. What do you do and how do you do it? I wanted to propose an example, one that we can use as a relative basis and not necessarily a prescription of how to do something. But if we look at bear markets, and we know that that's when markets drop, that average 38%, and let's say within an investment portfolio, we have some companies that we own, and then there are some bonds that we have in there. You have to take a look at what risk and volatility is and differentiate the two. So risk is the probability of a permanent long-term loss of value versus volatility is how significant an investment changes in the price up or down. And the difference there is that you can have volatility, but not necessarily a lot of risk. So initially when COVID was announced, we now know technology companies, this is really good for technology companies to create profits. When we're sitting at home, we'll watch more Netflix. We'll stay on Facebook. We'll get Amazon deliveries. But Amazon, Facebook, and Netflix, they all dropped at the same time when COVID was announced just like the other industries. So there was no differentiation. So that's volatility. And obviously there was lower risk because subsequently some of them are up 200% or more from that time, whereas other industries are struggling. So risk would be investing, let's say, in a cruise line or an airline company versus volatility for a tech company, them dropping in sympathy with everything else dropping. And then, so what I wanted to do is walk through an example, Jim, if we can do that. So let's assume that a business owner has $1 million, and they came into that money, or they had it invested already after exiting the business. And if the market drops 20%, there 20% drops happen on a regular basis. So that there's no reason to be alarmed, because every year we at least have once or twice where markets drop as much as 20%. The magical number is 20% because that's after a drop of more than 20%. That's when generally everybody is in agreement that we're in a bear market. So this is a little bit more of a serious thing that may last longer than a few months, and there will be a little bit of a prolonged loss or change in the dynamic of the market. And so if $1 million is invested, the first 20% we don't do anything. And then what we do is when market goes, actually this individual here for the first option is someone that says, you know what, I'm scared. Markets dropped 20%. I need to sell whatever I have. So that individual sells at the 20% loss. And he says, you know what, I'm not going to do anything until all the risk and all the fear is gone. Then I'll be back for the smooth ride. So the market does its thing, it drops, it rebounds, and now the individual from that million is now reinvesting 860,000 at a higher price, essentially positioning himself at a loss. So in this situation, individual number one lost about 20% of their investable assets as a result of this approach. If we look at individual number two, and this is the do nothing individual, I think there are majority of people take this approach where don't worry about it, it will work itself out in the long run. There is a lot of validity to that, definitely better than the first individual, where $1 million is invested, the market drops to negative 20, 30, 40, 50 perhaps, then market rebounds, you're still left with $1 million, which is a lot better than the 860 that the first individual had. If we look at a more proactive approach, individual number three has been invested, the market drops negative 20%, and then beyond at that point, we sell a little bit of those bonds that we had, and we buy some more companies or the market, and we do that along the way, and the market rebounds, and it comes back to where it was. This individual, through the downside of the market, actually made a profit. And it's important to say that we actually did not increase the risk of the portfolio. So it's not like one is speculating, I'm buying, and so this is not in haste, because when markets drop, that percentage that's exposed to equity actually shrinks and it becomes a smaller part. So then bonds as a relative basis just grow bigger as a percentage. So when you do a rebalance, you sell bonds to buy equity just to maintain that 30-70 split. You're just rebalancing to stay at the same risk tolerance. So you're actually able to make a profit that way of 14% in this case. And then often we hear of individuals that have made money through a recession, and that's how you do it. There's also a more proactive way of doing it, and this is, I think, where, Jim, a lot of business owners that are selling a business and coming into cash, the opportunity is that not only have you been saving perhaps into your RSPs along the way, but now you came into a larger amount of cash. And if markets are below 20, 30, 40, or even 50%, that is a tremendous opportunity. So we know some business owners that have just gone through a sale, and they are well positioned to take that kind of behavior into the market, which buying assets at lower prices, and in the long run them going up is what you would ideally want to happen. However, that doesn't, that's not an easy thing to do emotionally. I can show these graphs and it makes logical sense. However, there's a lot of emotions related to that, because you likely just came into the largest liquidity situation of money that you've had the potential to create in life, and you don't want to risk that. So This approach of which way do you go about it, it may be more of a broken down where you transition the assets from cash into investments over a period of time. It could be 6 months, it could be a year, it could be 2 years. The point is that the way that you transition is very important. And not only have you made a profit on selling the business, but you may be well positioned to make a profit as a result of where you're transitioning those assets into, like the market in this case. And that there's a number of steps. I kind of wanted to summarize it and break it down into a few steps that one can just think of, and it will depend on your risk tolerance. So when the market drops below 20%, do you have that risk appetite, or are you really scared? And the best thing that you can do is not sell and just stay where you are. And then you have to consider your personal situation. Do you have the time? Is there a source of income that you can rely on while you do this? What's your risk tolerance? And then how do you do it? Regular contributions? Do you have fixed income? There's different strategies of how to do that, and that's what myself and my team focus on, and understanding, because what we need to do is essentially, if a business owner is transitioning from, he understood his business really well, and he was an expert at it. He may not be an expert at the next phase in his life because he's just starting it. Like the first few couple of years maybe in the business that they exited from. And so it's about applying the knowledge that we have, but applying it in a way that matches with their goals. If it has to be, the goals drive the strategies. And there are, as you know from an accounting background, there are a number of different strategies, but great. How do you apply them that will match to your situation is really what matters. So that's where the conversations need to take place, so that we can prepare the individual to feel smart and to walk out as a winner.
I really find this stuff fascinating because I think the way the investment approach is laid out, it's really not that different than how business owners invest, and we've seen people react very differently in terms of how they have approached COVID. Some people will sit on their hands and say, let's do nothing, let's see what happens. And maybe they benefited from some of the government subsidies, and maybe they're in an industry where they had a bit of a pickup. But for the people who really were proactive and said, you know what, let's invest more capital, look for opportunities, those are the people who are going to come out ahead. I really believe, the key ingredient is planning, trying to understand the big picture, and ensuring that you understand what you're getting yourself into. And you've heard me say this many times, Martin. At the end of the day, I think you need a good game plan, and you can't be an expert at everything. So having people and the right advisors in your court makes such a difference, especially when you're looking at the sale of your business. We always tell people to give yourself at least 3 years to really start planning it out. Absolutely essential. And, COVID is one of those situations where if people were planning on retiring and they hadn't planned it out, they're probably in scramble mode.
Yeah, absolutely, I agree with you, Jim. So, 20 years ago when I started in this industry, myself or we did not have a team of specialists that focused and understood the specific needs of a business owner. We were generalists. I was a generalist initially, because you learn through experience the different needs of different individuals. And over 10 years ago, my wife, who's a partner in business with me, we decided we'll focus on incorporated individuals and assist them. And through the analogies that you just referred to, there are a lot of analogies. And what I find is, if someone who's in finance and is an advisor but does not have a lot of experience in dealing with business owners or incorporated individuals, you can walk through that and you can definitely get the assistance. But that feeling of confidence that the business owner has may not necessarily be generated through that conversation, because it will be more technical, as opposed to, this fits me because you seem to understand a lot of the things that I do. It's because we forced ourselves to deal with these situations on a regular basis. We chose the path of not working just with regular retirees, but with business owners who have a corporation. And there's another set of rules that you have to, and opportunities that come with it, and the mentality as a result. and the challenges and the experience that comes with it. So there are a lot of, and we learned that as we got to know each other, that there are a lot of analogies and similarities from your point of view, but from business owners, and it helps in the collaboration, of course, and which ultimately benefits the business owner who's going through the transition.
Absolutely. I think what I've learned too, even from the space that you work in, on the wealth management side, that not every advisor is equal. Specializations are important. I think, a lot of people who have gone through the sale of their business will realize that, there's tax implications and there's a lot of sophisticated items that one needs to consider. And if you fail to really recognize one of these elements, it can really hurt you in the long term in terms of what you're left with at the end of the day. And that's why, again, just to go back to my earlier point, having the right team in place, ensuring that you have a clear understanding of what you need to build in order to sustain your lifestyle, understanding, whether it's tax, whether it's, the true value of your business. All of these things are essential. So you don't want to wing it, as some people would say. You really want to make sure you have a handle on these things. And I think when you meet a good advisor, what you'll probably notice is that they're open to collaboration and they're always trying to learn. They're probably more specialized in a particular area than trying to cover off a bit of everything. So I don't know, is that your experience as well, Martin?
I couldn't agree more with you. How many times would you see people walking into the boardroom for the benefit of a business owner who's transitioning? Yet there seems to be this animosity or ego from the professional's point of view, whether it's an accountant with a financial advisor or somebody else, where they're trying to say, I'm the one leading this individual. I'm the one that they've been listening to. And sometimes you have to give in to that, perhaps just to not to create a little bit of a tight situation or pressure situation. But generally, there are changes that happen in a business owner's life. So if there has been advisors that have been leading a business owner up to the point where they exit their business, there has been a lot of work that will not be there anymore. And the same individual that led them through that process of starting, of growing, and there's a lot of friendship build over time, vulnerabilities that happen. That individual's part in their life may not continue at the same level because now there may not be a few corporations to look after and the same tax situations. You're entering a different phase in life, and that's where I see a handoff happens. And so this is where we decided right from the start that when we look at, which helped us in working with professionals, it initially, there would be tension perhaps, but if you understand that you need to create a holistic picture initially, and everybody plays a role, then they're your partners in helping the business owner exit properly and exit profitably. And then you let every single person play that role. But you also need to understand that everybody's role has a limitation. So not one person has all the answers. And sometimes you have to yield to the knowledge of another individual from a different industry that will create a better solution. So strong relationships are important, but also, as we've seen, individuals with knowledge from different backgrounds. That's where I appreciated very much you being in helping business owners exit businesses, but having the accounting background. It's a very different, and I've seen how business owners appreciate that versus having someone that is just doing a plain transaction in terms of a sales kind of a process where you're able to advise clients and they're a lot better equipped to address that conversation. And then we end up saying very similar things because we're not competing for attention. We're creating a cohesive, holistic, better outcome for the individual at the end, which then, that's dynamic. The more we expose ourselves to these interactions, the better it is for everyone.
No, I completely agree, and I appreciate those comments. I think at the end of the day, if everyone's centered around doing what's best for the client, it'll encourage collaboration, and it eliminates the tension, right? And just to leave folks with a bit of an example. I mean, if we're engaged in a deal and we're stuck in negotiation, oftentimes it's really helpful to take a step back and say, what does the true picture look like beyond the transaction for the individual? And I know we had a shared client in this situation, and what we quickly realized is, you know what, they can perhaps be a little more flexible on negotiation and take a bit of a concession because there's an opportunity to invest in the market. And if we were 100% focused just on the deal and we didn't consider the other factors outside their business, we would have missed the opportunity. So I think that's the value in ensuring that you've got your eyes wide open, you're willing to learn and listen, and do what's best for the client. At the end of the day, you will learn something through it and the client will benefit.
Absolutely. And I very much actually appreciated working with you in that specific case with the client, because he was a more sophisticated client from the fact that he had a little bit of experience and he knew how to be open the door to every professional that could assist him, and he was open to that, to learning and letting people work things out and play out the communication in front of him. So he saw what was happening, but he was not interfering, or he was very much open-minded to it, which was great to see. And thank you for that assistance. You really delivered well for this individual. Thank you.
Yeah, absolutely. Thanks for joining us, Martin. And this concludes part 3. And feel free to reach out to Martin. As mentioned earlier, he is specialized when it comes to business professionals and really understanding the business profile and the business setting and what it means from a wealth perspective.
Thank you, Jim.